Imagine this for a second. You're a landlord earning a solid salary, let's say around £60,000 a year from your job or self-employment. On top of that, your rental properties are doing well. They're throwing off another £40,000 in annual profit. On paper, everything looks great. You're earning six figures. You've built a portfolio. You're doing what most people would consider financially successful. But then the tax bill lands, and suddenly reality hits. That £40,000 in rental profit, HMRC wants £16,000 of it. Gone, just like that. 40% of your rental income wiped out before you've reinvested a penny, before you've upgraded a property, before you've strengthened your position as a landlord. And here's the part that really matters. Most landlords assume this is just how it is. They believe high tax is unavoidable. They think once you're a higher rate taxpayer, you're stuck paying through the nose forever. That simply isn't true. There are legal, well-established strategies that can dramatically reduce that tax bill. Some landlords are cutting their tax by tens of thousands of pounds every single year. A few are reducing it to almost zero, entirely within the rules. And today, I'm going to show you how that's possible. But before we break any of this down, I want to pause for just a second. If you care about protecting your property income, staying ahead of tax changes, and understanding how UK policy quietly reshapes your finances behind the scenes, then do yourself a favour right now. Hit like on this video and subscribe to the UK Property Report channel. We break down complex tax rules, legislation changes and market shifts in plain English, so you can make smarter decisions before they hit your bank balance. If you're serious about property in the UK, this channel is for you. All right, now let's carry on. One quick but very important clarification before we go any further. Nothing you're about to hear is financial advice. This is not a recommendation to take action blindly. What we've done is research the system, analyse how it works, and summarise the strategies that exist within the law. You must always seek proper professional advice before implementing anything we discuss. And just as important, this is not about avoiding tax. Avoidance is illegal. Everything we're talking about is legitimate tax planning, using structures that HMRC itself recognises. Right, with that out of the way, let's get into the detail. Using legal structures that any landlord can set up, higher rate taxpayers are slashing their property tax bills, sometimes by eye-watering amounts. After digging into the data and real-world case studies, I'm going to walk you through 5 levers that change the game entirely. Not everyone can pull all 5, but most landlords can pull at least one. And by the end of this, you'll know exactly which ones might apply to you. So first, why does this matter so much? Let me show you the maths that's quietly destroying landlord profits across the UK. Let's say you earn £60,000 a year from employment or self-employment. That already puts you firmly into higher rate tax territory. Anything above £50,270 is taxed at 40%. Now add your rental profit. Your properties generate £40,000 a year. Your total income is now £100,000. Here's the brutal truth. That entire £40,000 of rental profit is taxed at 40% because your salary has already pushed you into the higher band. That's £16,000 straight to HMRC. But it doesn't stop there. This is where things quietly get worse. If you get a pay rise, or one rental property has a particularly strong year, or you refinance and improve cash flow, and your income creeps above £100,000, you hit what I call the tax cliff. Once your income exceeds £100,000, your personal allowance starts disappearing. For every £1 you earn over £100,000, you lose £2 of your tax-free allowance. By the time you hit £125,140, your personal allowance is completely gone. What does that mean in real terms?
It means your effective tax rate on that income rockets well beyond 40%. In some cases, it's closer to 60%. A single extra £1,000 of income can cost you £600 in tax. That's not marginal, that's punitive. And there's more. If you have children, there's another hidden hit most landlords forget about: the high-income child benefit charge. Earn over £60,000 and your child benefit starts getting clawed back. For every £200 you earn above that threshold, you lose 1% of your benefit.
By £80,000, it's gone entirely. For families with 2 or 3 children, that can mean £2,000 to £3,000 disappearing each year, quietly, automatically, and often without people even noticing until it's too late. Layer that on top of higher rate income tax and the loss of your personal allowance, and your real tax rate is no longer 40%, it's significantly worse. Now add the final blow: mortgage interest relief. Since 2020, landlords can no longer deduct mortgage interest as a business expense in their personal tax return. Instead, you get a 20% basic rate tax credit. So if you're paying £10,000 a year in mortgage interest, you used to save £4,000 in tax as a higher rate taxpayer. Now you save £2,000. Your taxable profit jumps even though your real cash flow hasn't changed. And that extra paper profit pushes you further into higher tax bands, increases child benefit clawback, and accelerates the loss of your personal allowance. This is why so many landlords feel trapped. This is why thousands are thinking about selling up. The numbers don't stack anymore unless you structure things properly. Because here's the part most people miss. The UK tax system is not one size fits all. If you use the right structures, you can legally shift profits, reallocate ownership, and change how income is taxed without selling properties or triggering unnecessary fees. And that brings us to the first and fastest lever: the deed of trust. This is not new, it's been around for decades, but most landlords have never even heard of it. A deed of trust allows you to split the beneficial ownership of a property, even if the legal ownership stays the same. In simple terms, it says, yes, this property is in my name, but someone else is entitled to a share of the income. That someone else is usually a spouse or long-term partner. Here's how powerful that can be. Right now, you own a property generating £40,000 in annual profit. You're a higher rate taxpayer, so you pay £16,000 in tax. Now you save £2,000. Your taxable profit jumps even though your real cash flow hasn't changed. And that extra paper profit pushes you further into higher tax bands, accelerates the loss of your personal allowance. This is why so many landlords feel trapped. This is why thousands are thinking about selling up. The numbers don't stack anymore unless you structure things properly. Because here's the part most people miss. The UK tax system is not one size fits all. If you use the right structures, you can legally shift profits, reallocate ownership, and change how income is taxed without selling properties or triggering unnecessary fees. And that brings us to the first and fastest lever: the deed of trust. Now introduce a deed of trust. You assign 50% of the beneficial interest to your spouse, who is a basic rate taxpayer. That £40,000 is now split. £20,000 taxed at 40% equals £8,000. £20,000 taxed at 20% equals £4,000. Total tax, £12,000. You've just saved £4,000 per year. Over 10 years, £40,000, without buying another property, without increasing rent, without taking more risk. And it doesn't have to be 50-50. In some cases, landlords use a 99-1 split, where one partner earns very little. But, and this is critical, the split must reflect something real: capital contributions, mortgage payments, risk or involvement.
This document must be drafted properly by a specialist. If HMRC thinks it's artificial, they'll challenge it. Done correctly, though, deeds of trust are entirely legal, widely used, and well tested in court. And this is just the first lever, because next we move into something even more powerful. This is where landlords stop thinking like individuals and start thinking like a business. Partnerships. A partnership is exactly what it sounds like. You register your rental activity with HMRC as a formal partnership between two or more people. Most commonly, that's you and your spouse or partner, but it could also include an adult child or another family member. This isn't a loophole, it's a recognised structure in UK tax law. And it's incredibly effective when used properly.
In a partnership, you're no longer locked into rigid ownership splits like you are with properties held personally. Instead, you create a partnership agreement that sets out how profits are divided, and crucially, you choose the ratio. That flexibility is where the power lies. You could split profits 50-50. You could split them 75-25. You could do 60-40. Whatever reflects your real-world arrangement and makes sense for your tax position. Now, why is this often better than a deed of trust? There are three big reasons. First, a partnership clearly demonstrates to HMRC that this is a genuine property business, not just passive investment income. That distinction matters, especially for what comes later. Second, partnerships give you flexibility over time. If circumstances change, one partner earns more, another earns less, you can adjust the profit split year to year, as long as it's documented and justified. Third, partnerships open doors that are completely closed to sole landlords, and we'll come to that shortly. Let's walk through a real example. You and your spouse form a property partnership. You're the higher earner. Your spouse earns below the higher rate threshold. Your rental business generates £40,000 in profit. You decide to allocate 75% of the profit to your spouse and 25% to yourself. Here's what happens. £30,000 taxed at 20% equals £6,000. £10,000 taxed at 40% equals £4,000. Total tax, £10,000. Compare that to the £16,000 you were paying before. That's a £6,000 saving every single year. Over a decade, that's £60,000. Money that stays inside your property business. Money that can be reinvested into deposits, refurbishments, or simply strengthening your position against rising costs. Setting up a partnership is straightforward. You register it with HMRC, create a proper partnership agreement, and file a partnership tax return each year. The costs are relatively small, usually a few £100s to set up properly. But, and this is important, HMRC will look at whether the arrangement is genuine. If one partner does absolutely nothing, takes no risk, and yet receives the majority of the profits, that's where questions can arise. But if both partners are genuinely involved, even in different ways, and the split reflects economic reality, partnerships are well established and repeatedly upheld in court. Now, this is where many landlords make a very expensive mistake. They hear that limited companies are more tax efficient, which is often true, and they rush to move their properties into a company. And then they get hit with a tax bill so large that it wipes out the benefit entirely. Let's talk about why. Incorporation, the right way and the wrong way. On paper, limited companies look brilliant for landlords. Companies can deduct 100% of mortgage interest as a business expense. Profits are taxed at corporation tax rates, not personal income tax rates. That's currently 19% on profits up to £250,000, rising to 25% above that. For higher rate landlords paying 40% or more personally, that's a massive difference. But here's the problem. If you simply transfer your personally owned properties into a company, you trigger two immediate taxes. First, capital gains tax, based on the increase in value since you bought the property. Second, stamp duty land tax, because the company is effectively buying the property from you. We're not talking about small amounts here. For many landlords, this can mean tens or even hundreds of thousands of pounds, payable within 30 to 60 days. That's why so many advisors say incorporation isn't worth it. But that's not the full picture, because if you already have a partnership, something very powerful becomes available. Section 162 Incorporation Relief. This is where partnerships stop being just a tax-saving tool and become a strategic bridge. If your rental business is operated as a partnership, you may qualify for Section 162 Incorporation Relief. This allows you to transfer partnership assets, including properties, into a limited company without triggering capital gains tax. Instead of paying CGT up front, the gain is rolled into the value of the shares you receive in the company.
In other words, the tax is deferred, potentially indefinitely. Most landlords will never sell those shares, meaning the CGT may never actually be paid. And there's more. There's also stamp duty relief under Schedule 8, which can significantly reduce or even eliminate stamp duty on the transfer, depending on how the partnership is structured. Here's the key point. Neither of these reliefs is available to sole proprietors. If you own properties in your own name and try to incorporate directly, you usually get hammered with tax. But if you've been operating through a partnership, the rules change completely. This is why partnerships are so important. They're not just about saving a few £1,000s a year on income tax. They're about creating a pathway to long-term optimization. So the ideal journey for many higher-rate landlords looks like this. First, form a partnership and start running the portfolio as a genuine business. Second, operate that partnership for a period, usually at least a year. Third, incorporate using Section 162 relief and move the properties into a company without a catastrophic tax bill. Once the properties sit inside a company, the entire tax landscape changes, which brings us to the next lever. And this one is genuinely one of the most powerful tools available to landlords, yet almost nobody talks about it. Pensions and corporation tax. Once you operate through a limited company, you're no longer stuck with one rigid way of extracting profits. You have options: salary, dividends, and, this is the big one, employer pension contributions. As a company director, your company can make pension contributions on your behalf, and those contributions are treated as a business expense. That means they reduce your company's taxable profit.
Here's how this plays out in the real world. Your property company makes £100,000 in profit this year. Normally, you'd pay corporation tax on that profit, but instead, the company makes a £100,000 employer pension contribution. The taxable profit drops to zero. Corporation tax bill, zero. The money hasn't disappeared, it's gone into your pension, where it can grow tax-free. Now, I know what you're thinking. Great, but that money's locked away until retirement. And yes, that's broadly true, but here's the nuance most people miss. You're not losing the money, you're changing where it grows. Instead of sitting in a taxable company or being dragged into higher income tax bands, it's compounding in a tax-protected environment. And it gets better. Your spouse can also be a director. You can split pension contributions between you, and unlike personal pension contributions, employer contributions don't follow the same tight annual limits in the same way. The key test is whether they're wholly and exclusively for the purposes of the trade. Genuine pension planning for company directors is entirely legitimate and extremely common. The real power here is control. Each year you decide how much salary to take, how much to take as dividends, how much to push into pensions. Some years you might prioritize cash flow. Other years you might prioritize long-term wealth and tax efficiency. That flexibility simply doesn't exist when properties are held personally.
And finally, we come to the last piece of the puzzle, the one most landlords leave far too late: inheritance tax, protecting the portfolio you built. Let's fast forward for a moment. You've spent years, maybe decades, building your property portfolio. You've refinanced intelligently, you've managed tenants, you've ridden out interest rate cycles, you've handled maintenance headaches, regulatory changes and market uncertainty. And now your portfolio is worth serious money. Maybe you own 5 properties, valued at a combined £2 million, possibly more if you're operating in high-growth areas. On paper, you're wealthy. But here's the uncomfortable question very few landlords ask early enough. What happens to all of this when you're gone? Because without planning, HMRC becomes one of the largest beneficiaries of your life's work. Inheritance tax currently stands at 40% on anything above the £325,000 nil rate band.
Let's run the numbers. If your estate is worth £2 million and you've done no planning whatsoever, roughly £470,000 or more could go straight to the taxman. Nearly £500,000, money that could have supported your children, created generational wealth, or expanded the very portfolio you worked so hard to build. Instead, gone. And the harsh reality is this isn't a rare scenario anymore. Rising property values have quietly pushed thousands of ordinary landlords into inheritance tax territory without them even realizing it. But just like income tax, inheritance tax is heavily influenced by structure. And when properties are held inside a company, planning options expand dramatically. Using share classes to control estate value. One of the most effective strategies involves creating multiple share classes within your property company. Now, this sounds technical, but the principle is actually straightforward. You freeze the value of the shares you hold today while allowing future growth to accrue to shares owned by your children or a family trust. In practical terms, it means your estate stops expanding for inheritance tax purposes, even if the property portfolio continues to grow. Let's simplify that. Imagine your company is currently worth £2 million. Without planning, every pound of future growth increases the size of your taxable estate. But with the right share structure, you can effectively say, the value up to this point belongs to me. Future growth belongs elsewhere. Over time, that can remove hundreds of thousands, sometimes millions, from your taxable estate. It's one of the clearest examples of why early planning matters, because this strategy works best when implemented at incorporation, or at least early in the company's life cycle. Retrofitting it later is sometimes possible through gifting shares or trust arrangements, but timing becomes critical. There are rules, there are thresholds, and professional guidance is essential. But the underlying principle remains powerful. Control the growth, control the tax exposure. Maximizing the nil rate bands. Another piece many couples overlook is that the nil rate band isn't just £325,000. If you're married or in a civil partnership, both partners receive one. Used correctly, that's £650,000 shielded from inheritance tax before additional allowances even come into play. Add potential residence nil rate bans and careful structuring, and many couples can pass on over £1 million with little to no inheritance tax liability. But this doesn't happen automatically. It requires coordination. Ownership matters, share allocation matters, timing matters, and most importantly, starting early matters. Because inheritance tax planning is not something you bolt on at age 75. It's something you weave into your long-term property strategy. There is no universal best structure. Now, after hearing all of this, you might be wondering, so what's the best setup? And the honest answer is there isn't one single structure that works for everyone. The right approach depends on several factors: your current income, your spouse's income, portfolio size, financing structure, future acquisition plans, and how long you intend to hold the properties.
For some landlords, a deed of trust delivers immediate wins. For others, partnerships unlock medium-term flexibility. And for those building large, long-term portfolios, company structures often provide the greatest optimization. What matters is not copying someone else's strategy. What matters is designing a structure that fits your trajectory. The action steps most landlords should take. So here's the real takeaway, and this is where you separate passive landlords from strategic ones. First, don't wait until the end of the tax year. The biggest mistake landlords make is scrambling in March, trying to fix a full year of inefficient structuring in a matter of days. Call a property tax specialist now, before decisions get locked in. Second, audit your current setup. Ask yourself a very direct question. Am I leaking money through unnecessary tax?
Because if you're overpaying by even £5,000 a year, that's £50,000 per decade, excluding growth and compounding. Small inefficiencies become massive over time. Third, explore these tools in a logical order. Start with the quick wins. A deed of trust can rapidly improve income splitting. Move toward partnerships if you want flexibility and a pathway toward incorporation. Then consider company structures for long-term tax efficiency, especially if you plan to scale. And if your portfolio has the potential to reach 7 figures, inheritance tax planning shouldn't be an afterthought. It should be part of the blueprint. A moment of perspective. Here's something worth remembering. Tax isn't just a cost, it's a signal. When your tax bill rises sharply, it often means your wealth is growing. The problem isn't success, it's failing to adapt your structure as success expands. Sophisticated investors don't simply earn more, they structure better. They recognize when the rules change and they reposition accordingly. The landlords who thrive over the next decade won't necessarily be the ones who buy the most properties. They'll be the ones who operate most efficiently within the system. Let's bring this back to you. So now the question becomes personal. Are taxes quietly eroding your rental profits? Are you closer to the £100,000 tax cliff than you realized? Have mortgage interest changes pushed you into higher bands? Are you building a portfolio that could one day trigger a significant inheritance tax bill? And perhaps most importantly, are you structuring proactively or reacting after the damage is done? If you're already using some of the strategies we discussed today, I'd genuinely like to hear about it. Drop a comment below and share what's working for you. And if this breakdown has helped clarify the landscape, even just a little, take a second to support the channel. Hit the like button and subscribe to UK Property Report. We focus on giving landlords, investors and property professionals the kind of insights that aren't always obvious, the shifts in policy, the structural strategies and the financial realities shaping the UK property market right now. Make sure you ring the notification bell as well, so you never miss an update that could directly impact your investments or future decisions. Because in property, the people who stay informed are almost always the ones who stay profitable. Thanks for watching, and we'll see you in the next report.